Hi, this is Andy Hoffman of CryptoGoldCentral.com, where I publish a daily crypto-focused blog and provide professional crypto consulting services to individuals and altcoin developers alike. Last night, amidst at least the 100th crypto crash of 2018 and 1,000th since I first got involved 5 years ago, I told my wife that one day I'll write a book about my experience in the business world. Going back to 1989, I started my career selling certificates of deposit via cold calling. 5 internships later, I was in compliance at SG Warburg, a job from hell that would have killed me if not for Cantor Fitzgerald, the infamous bond broker on the top floor of the World Trade Center's South Tower, of which I could easily write a book in itself about, including my experience on 9/11 that permanently changed my life. From there, a Wall Street hedge fund that primed me for my first sell-side analyst job in the energy sector in New Orleans in mid-1998, just before the oil and gas prices crashed a few months later. On to my dream job at Salomon Smith Barney in New York in mid-99, just before the dot-com crash, where I worked for 6 incredibly rewarding but tumultuous years, finally leaving in early 2005 and starting my next career in the mining industry, with my first official job commencing in April 2007, the very month the TSX Venture Exchange, where most mining stocks are listed, peaked. 4 years later, I sold my last mining stock and started to publicly berate the sector despite still working in it, which is why it was such a godsend to be offered the position of marketing director of one of the nation's largest bullion dealers in October 2011, 1 month after the gold price peaked. More than 4 years later, I started investing significantly in Bitcoin. And finally, after 6 painful, in most cases miserable years in the bullion industry, I left it to start CGC, just in time for perhaps the biggest bull run in financial history. Even then, it wasn't easy. As atop the turmoil I experienced transitioning out of bullion, Bitcoin's scaling debate was a special kind of hell reserved only for the lucky few that ultimately was won by the forces of logic, yielding my biggest financial windfall since the mining stock explosion of 2004 to 2006, more than a decade before, which of course lasted mere weeks before morphing into the new level of hell known as 2018 that frankly hasn't been that bad in the big picture for those like myself who simply hodl Bitcoin and collect crypto dividends, like for instance B-Rhodium, whose long-awaited launch is rapidly approaching. Yes, 2018, the year of Bitcoin's Hoffman line, as coined by Adam Meister, i.e. the intense, relentless war for the $100 billion market cap I identified a year ago as the level institutions would flood into the market, which they did in November, and as a major support level the day after Mt. Gox's trustee first caused it to be tested on February 6th. Since then, the aftermath of the epic altcoin bubble caused by hot Wall Street money has been in many ways a prototypical market reaction, particularly in the hundreds of dot-com-like alts with no use case, many of them ERC20 tokens, created solely to benefit from the success of Bitcoin and Ethereum. Thus, a normal consolidation period after an historic price pump, characterized by a relentless stream of seemingly bad news, which in the big picture is in most cases inconsequential for Bitcoin, though it's of course portrayed as such by its myriad enemies, from status quo protecting institutions like Wall Street, central banks, and the mainstream media, to clueless cryptocurrency analysts, and of course, opportunistic FUDsters from both inside and outside the crypto community, preying on novices as they have throughout financial history. To that end, the year's supposedly most impactful stories haven't been anything that have given me the slightest fear regarding my unyielding strategy of hodling Bitcoin on offline hardware wallets, in my case, the Trezor. From the government standpoint, not much of anything negative has occurred, certainly not compared to 2017, when the Chinese government banned crypto exchanges. In fact, the US SEC ruled that Ethereum is not a security and likely in the not too distant future will approve one or more Bitcoin ETFs. Institutionally, Goldman Sachs acquired Poloniex through its ownership of the Circle VC fund. The IC's backed crypto exchange is scheduled to launch next month. BlackRock announced it is looking into creating a significant crypto presence, and numerous Wall Street firms, including Goldman, are looking into advanced custodial solutions. Technologically, the Lightning Network is advancing dramatically. Well, it's Bitcoin's hash rate has surged to a record high, SegWit adoption to more than 50%, and network speed to pre-scaling debate levels. Will's transaction fees have plunged to pre-Bcash spamming levels. Financially, a burgeoning financial crisis has manifested itself in the form of the worst fiat currency crash in years across a broad swath of nations, including all 5 of the BRICS nations, i.e. Brazil, Russia, India, China, and South Africa, where nearly half the world's population resides, let alone basket cases like Turkey, Argentina, and Venezuela, will so-called first world nations like Italy wrestle with the strains of major currencies like the euro. Meanwhile, the prices of precious metals, Bitcoin's so-called competition in the safe haven and inflation protection space, have plunged to multi-year nominal lows and all-time inflation-adjusted lows. In other words, Bitcoin has been amidst a bear market with no bad news, other than the consolidation of last fall's historic gains. And of course, the altcoin train wreck that continues to derail for the 95% with no viable, defensible use cases. In such an environment, the only thing that truly matters, in my view, is whether it can hold the Hoffman line valuation of a $100 billion market cap, which at current Bitcoin supply equates to $5,775. Not that it can't survive a brief decline below this level, but if it indeed maintains $100 billion amidst an environment of relentless FUD, where many altcoins continue to make new lows, it will validate my view that institutions see Bitcoin as a new major asset class that sooner or later they will significantly increase their investment in, particularly when mainstream vehicles like ETFs are approved or exchanges that are backed by mainstream institutions like the New York Stock Exchange and intercontinental commodities exchanges. To that end, we have again been thrust back to the fear stage, following August's ETF catalyzed plunge, September's altcoin Armageddon, and now October's multifaceted FUD machine that, coincidentally or not, commenced mere hours after the biggest financial market plunge of the year in both the stock and bond markets. Yesterday, when the Dow fell 830 points as interest rates broke above multi-year highs, well above the danger level I identified back in early 2014 of a 10-year treasury yield above 3%, Bitcoin was the day's best performing asset, and with it cryptocurrency in general, though clearly Bitcoin, rightfully so in such an environment, was the focal point. However, that all changed around 8 p.m. Eastern Standard Time when out of the blue, the entire crypto sector started plunging. In a matter of an hour, taking Bitcoin from 6,600 to 6,250 and Ethereum from 227 to 200, with most altcoins suffering percentage declines of 8 to 12%. Certainly not the first time this has happened this year, and perhaps not the last, which only time will tell as this unprecedented, world-changing asset class evolves. As always, my first instinct is to adhere to my Bitcoin mantra, i.e., don't look for bad news as there won't be any. That said, there will unquestionably be new forms of FUD to identify and analyze, as unquestionably they affect near-term price movements, particularly in altcoins with no reason to exist other than speculation, that won't end until the bubble's consolidation ends, hopefully sooner rather than later. In this case, there were multiple issues to choose from, some of which unquestionably have teeth, despite none meeting the definition of what I would truly deem bad Bitcoin news. From a lesser standpoint, you have background noise from the IMF, which warned earlier this week that cryptocurrencies could create new vulnerabilities in the international financial system that, frankly, I don't think played a part in last night's plunge at all. Next, it circulated that the Senate Banking Committee is holding a cryptocurrency-related hearing today. That, too, I give little credence to as a market-catalyzing event, as it doesn't seem to be about anything more than simple fact-finding. Third, we have news that at around 10 p.m. Eastern Standard Time, i.e. 2 hours after the decline commenced, a Bitcoin address was seen to have moved 22,000 Bitcoin in one transaction, though of course the who and where of the transaction are unknown. Could this have been a contributing factor? Absolutely, as we have seen numerous occasions this year of price declines around the time of big price movements, presumably under the assumption that big sales are about to take place. The Mt. Gox trustee is the best example, but a similar decline took place last month when a Mt. Gox whale moved 15,000 Bitcoin from a wallet that had just been unfrozen after 4 years. In this case, one would have to be a bit more conspiratorial to make the connection, given that the Bitcoin movement commenced after the price decline started. However, it wouldn't be unprecedented for insider trading to occur, even if it can never be proven. Lastly, we have the issue most likely to be the cause, even if 12 hours later, it's not certain if it's an issue at all, which is the time-tested FUD related to Tether, the US dollar-backed cryptocurrency backed by the admittedly shady but extremely large and influential Bitfinex exchange in Hong Kong. I'm not going to rehash the long, sordid, but extremely speculative history of Tether here, as the issue has been discussed ad infinitum for years. However, suffice to say, there are many in the crypto world that believe it to be unbacked by actual dollar assets or otherwise fraudulent. Yes, studies of its history and background have uncovered some extremely suspect issues, but the fact remains that to date there is no proof of such claims. And very recently, an independent audit demonstrated the assets were in fact backed. If someday it is proven that Tether is fraudulent, it will unquestionably have a huge negative impact on the crypto space, but in the big picture, should have zero impact on Bitcoin's long-term outlook, given that Tether, for all intents and purposes, has nothing to do with Bitcoin. That said, most altcoins need Tether to generate significant liquidity, so if so-called stable coins fail, it will be an extremely negative altcoin event. As for last night, there was lots of chatter about Tether, particularly after Bitfinex, which operates it, again was forced to deny accusations earlier this week of improprieties that in effect were based on nothing material. A brief dip in Tether's price coincided with the commencement of the crypto plunge, but as I speak this morning, Bitfinex's Tether price is exactly the peg price of $1, and the global average is 99.6 cents, slightly below $1, but hardly crisis-like relative to the amount of FUD. That said, it is certainly notable that in the past few days, the spread between crypto prices on Bitfinex and other exchanges has widened significantly, as evidenced by the current spread of $100 between the Bitfinex Bitcoin price of $6,300 and the Bitstamp price of $6,200. This is by no means unprecedented, but when it does occur, speculation increases that investors are trapped in Bitfinex and other exchanges, and thus would rather hold Bitcoin than Tether, the crypto equivalent of cash. This argument goes back to the Mt. Gox days, which I know well, as I had funds trapped there too, $1,100 to be exact. However, I failed to see why investors fearful of an exchange closure, or in this case, Tether failure, would believe Bitcoin would be any safer than cash. To that end, perhaps investors, during times of uncertainty, are merely seeking the safety of the more liquid Bitfinex exchange. So as usual, we wait and see if a proverbial smoking gun will emerge, which as of this morning, I've seen nothing remotely resembling. Or if, as in prior cases of Tether-related FUD, the fear subsides, the global Tether average returns to $1, and investors return to business as usual crypto investing. Either way, if you simply hold Bitcoin on a Trezor, you are immune to such issues, despite, of course, being exposed to the downside of fear-based speculation, which in all cases is far less in Bitcoin than altcoins. Hopefully this audio blog helped you understand the possible reasons for last night's price decline, heightening fears for some and assuaging them for others. As for me, I'll continue with the investing strategy that has been so successful these past 3 years, which from a risk-reward standpoint, in a world where unquestionably Bitcoin's use case and network effects are strengthening, is peerless, i.e. holding Bitcoin on a Trezor and hodling. Thanks and have a great crypto day.